If you're an entrepreneur and you're building your startup, one of the first things that you would consider is how can you get funded? How can you find investors for your startup? And this is certainly one of the major problems for entrepreneurs. Even more so for entrepreneurs that would like to scale their technology business, and so not only work domestically, but potentially then scale up at regional level. That would be very relevant for entrepreneurs in ASEAN region that would like to grow further. And so how can they find money, funding for starting up their business? How can they find this at the right moment with the right timing to build the venture? We need also to consider that now there are additional challenges. For example, in the United States, building a new technology venture became more and more expensive for the very reason that the access to the human talents, the human capital that you need to develop a new technology business has become incredibly expensive. It's very much challenging now to attract talents from Google or from Facebook, Meta now, to go and work with a new startup. And this is definitely a major development compared to 10 or 20 years back. So this is a challenge for a very advanced innovative economy. There is a different set of challenges for emerging economies, like majority of economies in Southeast Asia. And here the challenge is to actually have access to a pool of investors that can help grow and build the venture. So in this video, you will learn how to address this problem. So we will see what are the different alternatives for raising money, private equity, and under private equity we include primarily angel investors and venture capitalists. But there are also other options, including grants, debt financing, and so on. We will see also common ways to raise funds. In the process to raise funds, we will see the differences between these two key players that I just mentioned, the angel investors and the venture capitalists, which are both on the private equity market. We're going to see what are the different steps, the different stages of funding, depending on the size of a venture. And finally, we will examine when entrepreneurs should use their money or their family and friends' money, or when they should get investment from investors, from private equity, or whether they should get government grants, loans, and so on. And the very final part of the lecture will be 60 seconds on the rocket pitch or elevator pitch. So the typical type of pitch that entrepreneurs can use to convey the value proposition to possible investors. So without further ado, let's get started and let's jump right into this video lecture. So the first part will be to analyze the different type of option for investor to fund the business. Why entrepreneurs would go to investors to fund the business? So there are generally a set of challenges that entrepreneurs face. One typical challenge is on the cash flow, so to sustain financially the operation of a company. Another challenge, especially when you are building the company, will be the investment in the capital of a company. And generally the capital of a company at the very beginning will be to hire the key talents to grow the organization. And an additional challenge that entrepreneurs need to address together with investors is the product development cycle. So at the beginning, when you are launching your startup, you're also launching a product. So you're doing two things at the same time, building a new company, building a new product. And you want to build a new product right. But of course, this takes time because you will need to go through the different stages of product development. You will need to do your customer interviews, get the feedback. So this takes time. And even though you are adopting a very agile and very lean way, still, it could be year and a half, or 2 years before you can fine-tune, customize the product that you will offer to your customers. So to solve all these problems, what are the options for entrepreneurs? So one option is obvious, which is personal funds, family, friends, the savings of the entrepreneurs. Other two options include equity, capital, and this will be a big chunk of the video today. So how you can get investment capital in the startup. Generally, this will be the main avenue, the main channel for growing your startup. The second option is debt financing. So debt financing basically means to go and seek funding from a bank. So this will not be capital injection in the capital of a company. So it will not be risk capital in the company, but will be a loan. This is an option, but it's less likely to happen, especially with very early stage startups, because very early stage startups generally just rely on the idea, the vision, and possibly the execution by the entrepreneur. So we do not qualify for a loan and debt financing from a bank. And then we would also see like some creative alternative sources. One which is also available here in Thailand is crowdfunding, and in particularly equity crowdfunding. Equity crowdfunding, to make it simple, is a sort of like IPO of initial public offerings, which enable companies to get funds not only from private investor but from a public of investor through the concept of crowdfunding. So by being listed on a crowdfunding platform, an online crowdfunding platform. So this is one of the creative sources. Another creative source which I'm just mentioning, but we will not explore, we will not dig deeper, is an initial coin offering. So to use blockchain technology and cryptocurrency to fund your business development. One important point factor to consider is when you are going to this different type of investors, depending on the stage of development of your startup. So we generally divide into three main time frame. The first one is early stage financing. So this is when we have a pre-seed, the seed investment, and then the startup investment to grow the business and to achieve the new product development. The second category is the expansion and business development financing. This generally divided into different series A, B, C, D, and so on. And this is primarily to scale the company. And then the final type of funding that we're going to see is acquisition or LBO, leverage buyout. So all of these are under the big umbrella of merger and acquisition. So when companies are taking over another company, for example, a large corporate taking over a younger startup, which is in the same industry of an older company, and this is due to some synergies that can be strengthened by having the startup being taken over by a large corporate. So how can entrepreneurs prepare for the funding? So one obvious point first is to determine exactly how much the entrepreneur need, in considering that every time the entrepreneur is asking for funding, then he or she has to give something in exchange, which could be a board seat or some governance, corporate governance rule, so some privilege to investors, so some rights to the investors in the governance of the company. So the amount should be carefully thought upon by the entrepreneur. The second step is to determine what type of funding the entrepreneur would like to receive, and this It's not only up to the entrepreneur, but depends also on the stage of development of a company. Funding in the capital or loan. And then the final step is to develop the strategy for the entrepreneur to reach out to potential investors. So as I mentioned, the two largest alternative are the equity funding and the debt financing, which we will see a bit faster because it's less common for startup. So our focus will be primarily on equity funding, meaning investors that will invest in the capital, in the equity of a company, which basically means they will become owners, co-owners of a company, and they will get shares of a company as an exchange. So the type of funding or financing will be based on the stage of development of a company, but also the risk level of a company. So there are several characteristics, and whereby you can examine the different characteristics of your company and select what is the most appropriate form of funding or financing for your startup. When we go deeper into funding, we have basically two major options. The two major options are venture capital and business angels. Business angels or angel investors are generally at an earlier stage, whilst venture capitalists will come in at a later stage, at a more solid stage. Both of them are part of the big umbrella of private equity market. For companies that went through all these stages of funding, all the series that I mentioned earlier, A, B, C, D, E. So generally, if companies were able to achieve all of these to get fund at each series, at each round of investment, so these are companies generally with 7 to 10 years of life and operations. And if they grew constantly across 7 to 10 years, so this company are eligible to move ahead with an initial public offering. Initial public offering, which is they will start selling their stock, their share to the public in the stock exchange. So this is a big difference. Private equity, private investors. But when you go on the stock exchange, you are not working with private investors no more, but you're working with the public, with the market, with retail investors. So the private equity market, we can differentiate into three main categories. Individuals and angel investors will be under individuals. Other categories that are particularly important for Southeast Asia and Asia Pacific in general under individuals is family offices. Family offices are the investment offices of families, of wealthy families. So it's a very powerful investment option, especially in Asia Pacific. Crowdfunding, which we will dig deeper later on, it's also under this of individuals category of private equity market. Second one is venture capital. So under venture capital, we have many options and also many type of venture capitalists. Again, we are going to see this later on a bit more in details. Then the final one is private equity firms. So private equity firms generally invest in more adult type of firms. So rather than investing in early stage startup, they invest in adult firms. It can be even, like firms, legacy firms with 30, 40, 50 years of experience. Generally, private equity will primarily focus on restructuring. So for firms that might have been encountering some challenges, some problems, we need a new injection of capital, maybe even like a corporate reshuffle and a change of ownership, appointment of new CEO and new directors, and a new plan for restructuring. So this is a typical way for private capital private equity capital to work. So private equity firms will invest in legacy firms for further development or for turnaround plans. So focusing on the business angel first. Business angels is a typical American phenomenon, but we have seen these expanding in Europe, in Asia Pacific, and becoming more popular nowadays. So these are generally wealthy investors that will decide to invest in startup companies individually, so as private investors. There is not really one size fits all for angel investors, so they may have like different preferences in terms of range of investment, from very pre-early type of funding, $10,000 and so on, up to $1 million. In America, generally the average investment is around $500,000, but again, all these figures can change from time to time. These are generally less aggressive type of investors, so that they would like to nurture the growth of a company. So compared to other investors that will look at the return of investment more. So this is usually less of a concern for angel investors, because they want, most importantly, they want to grow the new venture, the new business. Venture capital is probably the most famous and also the most sought after by aspiring or new entrepreneurs. So venture capitalists are professional managers. So this is already a difference with the angel investors. So the angel investors are wealthy individuals that invest themselves, sometimes even making the investment under personal name without using any corporate veil to reduce the risk. But venture capitalists, they are investment managers, they are professional managers that manage a pool of funds provided by private investors. So we have generally wealthy individuals, families, and so on, pooling their money in a venture capital fund. Then the venture capital fund will invest in the technology startup. So here it's a very important point to remember, because venture capitalists are professional managers, which means that when you're addressing them, you need to address them considering that they are investing the money of someone else. So they have duties and responsibility towards their investors. There are different types of venture capital firms. So we have the typical private venture capital firms with the general partners, professional investors in the limited partners. They are the investors that provide the funds to the VC firm. We have, especially in the United States, a small business investment company. We have industry sponsor, what we generally define as CVC, corporate venture capitalists. So this could be owned by banks or could be owned by corporate. This is an extremely important source of funding, especially in Thailand, because all the major VC in Thailand are actually CVC, are corporate venture capitalists belonging to the largest financial groups or the largest industrial groups of the country. We have also geographically oriented VC. So these are VC with a specific target. So there are, for example, VC in America that we focus only on the Bay Area, Silicon Valley, or the other VC that we focus on other markets of the United States, specifically because they don't want to be in the most competitive market, which is the Bay Area, and then they select other type of geography and they have that specific expertise. Or there are global VC funds that operate in all the major innovative district, or other funds that have a specific preference on some regions, for example, Asia Pacific oriented funds or ASEAN oriented funds and so on. One additional type of VC is the university sponsored VC or UVC. So this is essentially a holding company which is owned by university, and then this VC, well, generally this type of VC will specifically nurture research, patents, technology created by the university will help this research to be commercialized. And by doing this, we will also provide an investment as a university venture capital, which sometimes can be also co-invested by other venture capitalists. So this is an additional option, an additional type of UVC. In the UK, in the United States, UVC have been extremely successful in nurturing new technology and promoting the commercialization of new innovations. Final type of venture capitalists are more like philanthropic venture capitalists, so that they invest considering social innovations as well. VC is actually a quite recent business. So the first VC were actually not even 100 years old. So where they were created after the Second World War. However, what really pushed, what really made the venture capitalist so crucial for the innovation enablement in an economy was when all the large professional investors, like for example pension funds in the United States, were allowed to invest in venture capitalists. So when this happened, this was really a turning point, because a lot of new money, new cash flew into VC, and this new cash was used for the development of new innovation. And this actually led the US to become the most innovative economy. If we look at the data, and there is a very interesting research, a recent research, which is titled The Economic Impact of Venture Capital with Evidences from Public Companies by Gornell and Strebulev. So based on this research, we can see that originally G7 economies, so the United States and the largest European economies and Canada, so originally in terms of level of innovative firms, they were all similar. Of course, like proportionated to the size of the economy, because the United States has always been a larger economy. But considering this, the level of innovative firms was exactly the same. However, as soon as pension funds and all the institutional investors could invest in VC, and this gave a boost to the VC industry, and with all this new cash that could have been invested in innovative firms, so this really let the United States stand out of the crowd and become such an innovative economy over the past 40 years. So VC, the objective of VC is to help young firms with technology content to grow and to achieve the break-even and then profitability. VC don't want to manage a company, so this is very important. VC do not manage the companies, but of course they would like to be able to control how the company is managed, whether the entrepreneur is on track to achieve his or her own objectives. So generally, venture capitalists, on top of rights as shareholder of a company, they will also have some seats in the board of a company to enable them have this control on the operation of a company. Of course, many entrepreneurs will go and seek investment from VC. So business plans and the way entrepreneurs adopt the strategy to approach VC it's extremely important. So VC will screen a lot of business plans that we receive, So the business plan will be used as a first way to test the waters with a possible interest of VC. The second stage, if there is some interest from VC, that would be an agreement on the general terms of a possible investment. And then before the approval, there will be a due diligence. So due diligence is when the VC will be checking this the feasibility of the idea in case it's an early stage VC, which, by the way, now it's more and more common to have also this early stage VC, or in other cases, a VC will investigate whether the company is strong enough for the investment, whether everything is in healthy condition, financials are in healthy condition, no one cooked the book of a company or something like this. And finally, this will lead to the final approval with a memorandum that will spell out the terms of investment, the rights of a VC, and so on. So entrepreneurs should know what type of VC they would like to address. We should understand also the focus of a VC, geography of investment of a VC, and so on. It's also important that the entrepreneur will go and pitch with the key members of a team, so to show that they are fully committed in developing this business with the support of a venture capitalist. A key consideration, especially for internet companies, is that there are some metrics that are specifically for internet companies. I'm not going to investigate all these metrics today because it will be too much for the video. But metrics like lifetime value, the cost of customer acquisition, LTV, CAC, or the rule of 40. So all these metrics specifically for software as a service, digital companies. So these are key factors that VC will consider. Anyway, these type of metrics, we can study them further in a different video. What will be the deal structure with VC? So the deal structure will be arranged in a way that the rate of return, the timing and the form of return of investment, the control desired by the VC and the shares that will be allocated to the entrepreneur will be carefully considered. Entrepreneur should also spell out what kind of governance he would like to adopt for the company, how much he needs, and also how this investment will enable the company to grow further and to achieve the objective. There are different level of financing, different level of risk as well. So in level of risk will have a different return on investment. And so as you can see, for early stage startup with highest level of risk, so the return of investment requested by VC would generally be around 50%. For the development financing stage, so here the ROI will be around 40%. For acquisition, so with a lower level of risk, so this would be around like 30%. After the stage of a private equity, we've seen that private equity will go on from the angel investor to VC, and VC will consist of many different series of investment. This first round at pre-seed, and then the rounds when the company is growing the business, so Series A up to Series E. So after this, then there will be the option of initial public offering. Initial public offering is when the company, which is entering the adult stage, so we start selling the stock to the public on the stock exchange. Many companies in the US will prefer to go on the NASDAQ, which is a stock exchange specifically for technology, biotech, and smaller companies. There are equivalent of a NASDAQ pretty much in every jurisdiction, every legal system, including Thailand, there is a market which is a market of alternative investment of a stock exchange of Thailand, or MAI. So most of young companies are listed on the MAI in Thailand. Why firms would like to go public? So this is because they may need further equity to fund their operation and their increased scale. We also want to make their reputation higher, because through the IPO you will basically access a club of a very exclusive club of listed company. IPO will guarantee higher liquidity to the company, and finally the IPO will guarantee the company a sort of currency. So this might need some additional explanation why we say that this would be a sort of currency, because when you are a listed company, then if you want to do either acquisition or merger, so then you can use your listed shares on the stock exchange, and you can exchange this towards the shares of other companies, and this enable you to do all these extraordinary operations, primarily mergers and acquisition. So you don't have to use cash all the time, but you can use this as a currency. Alternative to equity financing, we also have debt financing. Debt financing is less common for startup, so it will be generally used by a startup when they achieve some stage of development, and thereby they have some fundamentals that they can show to the bank to receive a loan. What are these fundamentals? To be eligible for a loan will be one, strong cash flow from your operation, which of course means you can't be an early stage startup, because generally you don't have any cash flow at that time. You don't have a high leverage, and you have all your financial statement being audited by auditors. You have a good management and a good governance, and overall you have a healthy balance sheet. So all of these criteria, if you fulfill all these criteria, then you are eligible for debt financing. Other sources of debt financing include also peer-to-peer lending. So peer-to-peer lending is essentially just a way other individuals are giving small loans to other individuals or to businesses. So this is also a way to have access to crowdfunding. However, about crowdfunding, I would like to rather focus on a different type of crowdfunding. So we can consider all the different type of crowdfunding as the debt-based crowdfunding, which I just mentioned. Peer-to-peer lending is a type of debt-based crowdfunding. We have also donation-based crowdfunding. Donation-based crowdfunding is, for example, Kickstarter and similar platforms. We have reward-based crowdfunding. So when we are giving some sort of reward to the people contributing to crowdfunding, but the one that I would like really to focus on is equity-based crowdfunding. So equity-based crowdfunding is similar to an initial public offering. So through the equity-based crowdfunding, companies, even early-stage startups, are raising funds from investors and from the public through the equity crowdfunding platform, and through this funding they will finance their operations. So this is extremely important. It's a new tool that is also available in Thailand. In Thailand there are some equity crowdfunding platform. Sadly, the legislation, even though Thailand was one of the very first to enact legislation for crowdfunding, but the legislation was quite strict, and consequently, crowdfunding didn't have so much success as it was expected. However, there are a few options of equity crowdfunding that are active on the market. And so this could be definitely a very good way to grow further businesses in Thailand. So in Thailand, as you can see, what are the different stages of funding? So business angels investors generally will fund up to around like $300,000, which is the equivalent of like 10 million Thai baht. Venture capitalists will be above 30 million Thai baht, which is more than $1 million, roughly. Then we have private equity, and finally, what I mentioned earlier, the market for alternative investment, or MAI, which is the stock exchange for small capitalization company in Thailand. So there is an area which is a gap in the Thai equity capital market, which is between 10 million up to 30 to 40 million Thai baht. So this is the area where equity crowdfunding through retail investor and qualified investor can fill the gap. So this is a way that can help grow further the possibility of funding for Thai startups and also for Thai SMEs. So on moving towards the conclusion of the video today, so a few other creative way of funding besides equity crowdfunding is to find some strategic partners. So partnership can be, especially with larger industry, could be a way to find the type of funding or the type of support, which is not always related to funding or can be supplemented in a different way. For example, with an industrial partner giving technology support or providing people for the startup for the new startup as a partner to develop a new initiative. So to an extent, through a cooperation between startup and strategic partners, this can really lead to a new way of creating new sustainable innovations. The final 60 seconds of the video is on the rocket pitch or elevator pitch. Why rocket pitch? Why elevator pitch? Rocket pitch was called this way because it's like the launch of a rocket, which should take 60 seconds. Or elevator speech, it's because it's, when you are in the elevator, you imagine to be in the elevator with, in Thailand would be probably the head of investment of SCB 10X, or if you are in the United States, could be with corporate venture capitalists or with some leading venture capitalists in the US. So how you can convey the value of your company, how can you convince investors in a very powerful way between 45 up to 2 minutes on the value of your company. So there are some steps that you can follow for this. So 20 seconds will be committed to the problem definition, 20 seconds on how your product meet the opportunity or solve the problem that you define first, then your qualification, and finally the market. So this is a good way whilst you are looking for talking to VC, or even before VC, talking to angel investors to find possibility of investment in your innovative startups. So practicing the elevator speech, which you can actually practice not only with your peers, you can literally practice with anyone, going maybe some events like networking events, chamber of commerce events, industry association events. So it's actually even better in this sort of context to try and just practice how you would do in real when approaching an angel investors, or even better in future, a venture capitalist. Thank you for watching, and see you in the next video. Bye.